Hi, this week we have three interesting webinars lined up for you. First one is on top biases you should fight. This webinar is happening at 10 a.m. At 12 p.m., we have navigating the cement business. We have another webinar at 12 p.m. which is using MFs for asset allocation. All the registration links for the webinar are given in the description below. Do register. Thanks.
Welcome to this video for ithought Connect, where we're going to decode the Federal Reserve's monetary policy announcement. So if you stayed tuned to what the Fed had to offer in their June meeting, you would have noticed that interest rates have gone unchanged and the expectations kind of remain as they were a couple of months back. But let's get down into the details and understand what went on in today's policy. We'll begin with the holy trinity of inflation, growth, and unemployment. So if we look at where inflation is today, the Fed's terminology was that inflation remains somewhat elevated. And if we look at where the inflation projections are, in March, the SEP showed that inflation for 2025 would be at around 2.7%, but that has increased to 3% today. If we look at the next lever, which is unemployment, the Fed described labor market conditions as solid, and there has been a slight uptick in the unemployment expectations between March and June. So in March, the expectation was that the unemployment rate would be at 4.4%, but now it's been revised upwards to 4.5%. Now, historically, 4.5% as an unemployment level is low for the US economy. So this is not something that's causing the Fed undue concern at this point in time. Moving on to the third pillar of growth, we need to see where the growth expectations are settling in. The expectation in March was that the US economy would grow at 1.7%, but it is now slated to grow at 1.4%. This being said, the Fed maintained a confident tone and said that the economy continued to grow at a solid pace. Now that we've unpacked the data points, let's take a look at how investors should perceive this. A higher level of inflation, a lower level of growth, and a higher level of unemployment are not a good mix together. So investors need to be a little bit more cautious about how the US economy is positioned, and it does warrant a need to study your portfolios and understand what the global risks could be. If we look at where interest rates are expected to go, given that the Fed published a dot plot this year, there is an expectation that there will be 2 more rate cuts, and the Fed funds rate will go from 4.25% to 4.5% to 3.9% by the end of the year. So if you look at that interest rate differential between 4.5% and 3.9%, you know that there's roughly space for 2 rate cuts to happen. Given that this is a month where the Fed shares the summary of economic projections, let's take a quick look at where individual members of the FOMC committee actually expect interest rates to go. So if we study the dot plot for 2025, what becomes apparent is that 7 members expect interest rates to go down 1 notch, that is by 0.25%. 2 members expected to go down by 2 notches, that is by 0.5%. 8 members expected to go down 3 notches, that is by 0.75%. And another 2 members expected to go down by 4 notches, which is a whole percentage in terms of interest rate cuts. So this is a very interesting split between how the Fed is thinking about the trajectory of interest rates in 2025. What are your thoughts on where the Fed is going with their interest rate cuts? Let us know in the comments below.